Diane, I came back from San Francisco in June after visiting there with my family, and it's absolutely heartbreaking to see just how the city has been hollowed out, and that's really the stark reality of the stress in commercial real estate. Have we seen the worst of it?
No, we haven't. And in fact, the bulk of the commercial real estate that resets in the leases is still ahead of us. And that's one of the other things that's out there. And we know that commercial real estate is in the banking sector more. It is among some of the smaller banks more. And these are things to be watching for, because there is going to be a reset, even in places like Houston and Dallas, where occupancy rates are much higher than places like Chicago or San Francisco. They're still running at 60% occupancy. The official vacancy rate on offices is around 19%. That's what it was during the height of the S&L crisis in the early 1990s, when they had the Resolution Trust Guarantee Fund to resolve the bad bank and all the bad loans in commercial real estate. Now, it's only the office sector. It's not across the commercial real estate sector. But I do think we're going to see a lot more losses in commercial real estate. This year, the numbers aren't as big as they are next year. And so that gets to be pushing out when we could hit this tipping point. And remember, the worst of the pain is not as the Fed's raising rates, but it's after they hit the peak in rates and hold them there. And remember, real interest rates continue to rise as inflation cools. And so we are moving into what could be a much tighter credit conditions, but also a preemptive pullback by banks, knowing that they have these what could be larger losses in commercial real estate to deal with as well.
Diane, we got two inflation reports, two jobs numbers, and Jackson Hole before the Fed needs to make up its mind at the next meeting. If we do continue to, first of all, do you think that we're going to continue to see inflation moderate? And are there going to be any signals from Jackson Hole, especially about rate cuts potentially in 2024?
Well, I'll be at Jackson Hole, so we'll see. I don't think we're going to have another mic drop moment like we did with the 8-minute, 34-second speech Jay Powell gave last year at Jackson Hole, which was stunning. That was really something. I think this is more, you really see the Fed trying to back out of forward guidance right now. They're not trying to get ahead of themselves anymore. But I think what's important about the numbers, first of all, the overall inflation numbers, we just hit the sweet spot of, year over year peak in June of last year. So, of course, it's going to be weaker now. We do have some things picking up. The core inflation number, even if we don't get a big inflation number in the month of July, when we get that data in August for the July inflation number on PCE, it still picks up. And so we know that over time it can come down, but you really need a pretty sustained deceleration for the Fed to really feel comfortable. And that's why they're not declaring victory yet. Yes, it's at 3% right now, but that's going to move around a little bit. It will continue to improve in general, but the core inflation is, they're worried about a floor being set in the service sector.